Mark Twain said this, that history never repeats itself, but it does rhyme. And you can see that on slide 23. We've taken the red line, which is the BSE 30 index, from its January 2008 peak to present, right? And at the bottom of the scale is the number of days since then. And the blue line is the BSE 30 index from its November 2010 peak of 21,000 to the present. And the similarity is actually quite stark. Fears of inflation from November 2010, the price of onions and rice and wheat and oil went up in India. And much of the discussion, and for the first half of the year, for this calendar year, has been inflation. And Indian stock markets, like many emerging stock markets, began to come down in price. Then fears of inflation sort of went away. Indian stock markets went up a bit. And now we've got sovereign debt crisis or sovereign debt fears. And that's again brought the Indian stock markets down. So the blue line seems to be fairly closely tracking what the red line is doing. Now, it could happen that tomorrow the US declares bankruptcy or Greece declares bankruptcy. It could happen. Or a currency falls out of favor, the US dollar or the euro or someone out there. And there's a crisis. And the blue line goes right down, just like the red line did. It plummets. It could fall 50% in 5 weeks, just like the red line did when Lehman crisis happened in 2008 September. So keep in mind that an index of around 16,000 where we are today, in theory, the index could actually go back to 8,000 tomorrow if all the foreigners decide to sell. If foreigners sell $10 billion in 1 month or $10 billion in 2 months, the Indians, our local Indian power, is maybe 2 billion a month, 1 billion a month. We can't absorb their selling. More sellers, fewer buyers, price of that product comes down. More sellers of the BSE 30 stocks or any Indian stock, fewer buyers of us in India, the price of shares will come down. What will make them sell? It is not the earnings downgrades. It is not earnings failure in India. It is fear factor of something outside India. So it can come down. Here's a man who's saying the index can be 29,000, 30,000 or whatever by July 2012. And here's a man who's also saying that please recognize that because of some fear of something happening outside India, right, the Indian stock market could collapse by 50% in a month, as it has already done 3 years ago in September 2008. Of course, the Indian stock market could also collapse if there was a war between India and Pakistan, for example. It doesn't have to be an external factor. It can be an Indian factor, which causes foreigners to sell. But it is the foreign selling that brings it down, not the Indian selling that brings it down. That is the key point. It is the foreign buying that brings it up, not the Indian buying that brings it up.